Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. Well, governments and central banks all over the world have taken unprecedented coordinated actions in the past 30 days in an effort to help financial markets and economies operate normally once again. One analyst I read was even quoted as saying they've already thrown the kitchen sink at the problem. I guess the next step is the bathroom sink. That brings us to the topic of rate cuts once again. More of them by central banks seem to be a certainty at this point. In fact, some on the street are betting that our Fed will be cutting rates by 0.75% later this week. And there's even some talk of yet another stimulus package here in the United States. How does our astute panel feel about all of that? Well, that's what we're going to find out today with Steve Reitmeister, our editor-at-large at Zacks.com, Charles Rotblut, that senior market analyst, and, of course, Zacks maestro of stock screens, Kevin Matris, all here at the round table. So, Charles, let's start with you. Some people say we're going to go down to 1% later this week on the Fed funds rate. Some people say we're going to maybe see 0.75. Some are even saying we may see 0, not in the too distant future.
Well, as you can see by this complicated chart here, this is actually prepared by the Cleveland Fed, your tax dollars at work. Mm-hmm. But what it does, it actually shows the various probabilities future traders are actually pricing in. The tallest line right now is a purple line way at the end, and it's implying about a 45% chance of a 50 basis point cut. Okay. So traders are most likely saying that's the most likely. The next actually highest probability is a 75 basis point cut. But you can tell by all the lines and how close they are together, mm-hmm. various possibilities really going from 0 rate cut to a very large rate cut of over 1%, right. Complete cut. So there's a lot of uncertainty on the part of the traders, a lot of questionable. Most likely, we will probably see a 50 basis point cut at this meeting. What's interesting, if you actually go out to December, which is the next chart, we're actually looking at rates holding at 1%. Now, keep in mind, if we go back a couple months ago, some people are actually forecasting a rate hike at this meeting. Yep. So we've had a complete about-face in terms of what some people are calling for in the expectations. I think the takeaway for investors right now is that we're not exactly sure what the Fed's going to do. Most likely, half a basis point, possibly 0.75. But keep in mind that we are dealing with a psychological problem. And I have a chart right here showing LIBOR rates. And we've actually shown the credit crunch, or really the credit freeze, starting to loosen a little bit. And what that's implying is regardless of what the Fed does, some of the actions they've taken have already helped. So this is really more to kind of react to investors and kind of show them that, yes, the Fed's being proactive. Yes, the Fed's aware there's an economic problem on top of the credit crisis, and they're trying to do something.
Yeah, I think being aware is fine and good, but Kevin, what do you think? No matter how much money they throw at the problem, it doesn't seem to be pulling us out quick enough.
Well, I mean, you have a lot of different problems. A lot of people think that the Fed lowering rates is probably the least important thing they can do at this point. But getting back to what the Fed is likely to do on Wednesday, it's likely they're going to probably be cutting a half a point. We should see the Fed funds rate down to 1%. What's interesting, though, is that this would put the rates the lowest they've been since 2003 and 2004. And what's ironic is that a lot of people had believed that rates being so low for so long is what partly caused the housing bubble in the first place. Mm-hmm. In my opinion, I think the overly aggressive rate hikes going from 1% to 5.25% is what ultimately popped this bubble in the first place. But I just find it ironic that one of the main reasons why we're in this mess is because we are at 1%, and here we are trying to be able to get back to where we were. Hopefully we don't repeat the same mistakes. This should be able to spur the economy, should be able to help business, should help consumers, and hopefully it will get housing prices and home buyers back into the market. So,
Steve, where do you think the cut's going to go, and will that cut help the stock market?
Yeah, it doesn't matter if they go to 1 or 0.75. I don't think that really matters at this point, because I think they're going to use all the ammo they have. This is one of the easiest bits of ammo that they can put out there, one of the less expensive bits of ammo they can put out there versus some of the other flavors. So whether they do it in 1 step, 2 steps, they're going to take it down quite far, and because they're have to put out a lot of medicine. But what you said is it's not working fast enough. Well, says who? What we're talking about here is 70 years of build up And so, fear and greed cycles, and the greed cycle just got a little ahead of ourselves, and we have to give it back. Plain and simple. That's the way it works. And so the Fed is, and the Treasury are trying to do things that help, here again, mitigate some of the short-term damage. So if the free market were to take care of this, it'd be incredibly painful right now, and then we'd be back out within a year. Okay, but the devastation in that period would be like really like wringing out a rag.
Right.
The Fed and the Treasury are trying to spread out that pain over a period of time so it's not as devastating, because that can cause just far too much fear. And here again, people want to get reelected. If they say, well, we're just going to pull back and not do anything, it's hard to get votes when you do that. Okay, so which is better? It doesn't matter which is better, because we're not going to get free market solutions. Okay, we're going to get something that the government's trying to step in and do things. Will they do it right or not? I don't know. Okay, what I know is this problem is serious. It will take its time to work out. But what does serious mean? We've spent some time here talking about where the market bottom might be. None of us here would be shocked to see us dip into the 7,000s. But here again, none of us would be shocked here to see 3 years from now us back at 10,000 plus.
Right, and at this point, nobody's really willing to call that bottom.
Right. So, yeah, and we're not pretending to know exactly where that bottom is, but given reasonable calculations of where fair value is and where the market goes, 7,000 or 7,000, 7,500 is not unreasonable. But here again, 10, 12,000 on the Dow 3+ years from now is not unreasonable either. Right. So that's what we're saying. Long-term time horizon, be in the market. Short-term time horizon, yeah, you might want to stay a little bit to the side and start working your way in if we cross over into the 7,000.
And one thing I'd like to point out, this stimulus does work, and it works a little bit quicker than anybody expects. We do run the risk of inflation. For an investor, that means at some point it would make sense to get back into commodity-related stocks. Not right now. We're looking at some weakness because of the economy, but as we start seeing inflation kick back and the economies accelerate, we will see increased demand for commodities, and also just with higher prices as a result.
Well, he said those two magic words in the same sentence, stimulus and economy, which leads us to the next topic that's out there on the table. Some people are saying on the street it's stimulus time once again, time to kickstart, jumpstart this economy that seems to be going further into the quagmire. But this time around, what a lot of people are beginning to talk about is the employment picture in relation to the slowing economy or the downturning economy. And one analyst who I read just recently said that if people don't get jobs and don't go back to work, or the unemployment rate doesn't stop escalating, they're not going to have the money to spend anyway. So it doesn't really matter if you stimulate or how you stimulate at the federal level. What are your feelings on that?
I'll take it. I mean, the second stimulus package, they are saying that it's going to go towards infrastructure. They're saying it's going to go towards job growth. They're going to be extending unemployment benefits. Is this going to have an immediate impact? Probably not. But again, getting some additional money into people's pockets will probably help create a bridge and buy the consumer and businesses some time to be able to make it to, the next point, whatever that point is. Whether or not we should have a second stimulus, I know there's a lot of debate.
We're not talking about checks this time either to consumers.
Right. But again, whether we have a second stimulus, some people are saying that it's absolutely uncalled for. Other people believe that it's something that should be done. As far as getting more money into people's hands, we've kind of had already a de facto second stimulus package anyways, with the price of oil going down so much. Steve had brought up an interesting stat a while ago saying that for every $1 change in the price of oil, that represents an $8 billion tax on the economy. We saw the price of oil go from 145 all the way down to below 65. That is a huge decrease in oil, and that represents, if you do the math, like a $640 billion burden removed from the economy.
Annually, yeah.
Right. So that's going to help put more money into people's pockets by not having to spend so much at the pump.
Right.
But again, if there is another way, Bernanke, he is in favor of a second stimulus. If this does go into the infrastructure and to be able to somehow create a situation where there can be more jobs. look, I mean, 70% of GDP is based on consumer spending. We need to make sure that that consumers are working so they can spend.
Well, if they support the infrastructure, they're going to have to work through state and local governments to do that, I would guess.
Yeah, there's quite a bit of that. I agree with the no checks this time, and I certainly agree with the concept of there's going to be some folks who don't deserve to lose their jobs, and there are going to be a lot of pain to extend benefits to them. That's something I absolutely believe in. But here again, getting back to that thing, will these things work? Well, they may work in time, but we're all going to have to take our pain over the next year or so in the economy. Okay, and so a lot of that's priced into the market. Probably got a little more to go, and that's what I just keep getting back to. I'm not going to try and predict what policy they're going to come up with. I'm guaranteed that it will be wrong. I'm saying that they won't choose the right policy, but they're going to try and do something terrific. That's what we're getting paid to do. What we have to realize, I think Kevin's right on the money, is one of the if there is an upside to a recession, is that prices come down. Okay, prices come down, and that has a stimulative effect. That in time, people will want more than a 0.5% return on their money in a savings and checking account, and they will work their way out from underneath their beds and try and find a better rate of return, whether that be the stock market or even the bond market. Some of these things are completely mispriced, or starting up a little business or whatever, and so these things will take place. So 2 years from now, we will be in a much better shape than we are today. The next year, the numbers are not going to be good. Right. And no matter what they do.
Charles, quickly, recession stimulus package.
Yeah, one thing I want to point out, though, is if you believe the poll numbers and assume that Barack Obama is going to win the presidency and the Democrats take control of both the Senate and the House in terms of majorities, they're going to want to push through some stimulus package. As Steve said, it may not be the best package, but they're going to try and do everything they can to say, hey, we turn around the economy. The reality is, regardless of who's in the White House, whether it's Barack or it's McCain, the economies go through cycle. We have periods of expansion and periods of retraction. Right now, we're in a period of retraction. It will work itself through. What the government's trying to do right now is try to ease the pain and help the recovery come that much faster. But I think it's important to note, regardless of who's in office and who takes credit for whatever stimulus package occurs, it probably would have recovered by itself anyway. We're starting to see the credit markets thaw. But certainly, what the big mistake happened in 1929 was the government did not act fast enough, or really didn't do anything initially to try and ease the pain. And that's what made matters worse. Right now, we're in a completely different environment. You have a proactive government, a proactive central bank, and that alone is going to help a lot, even probably more so than any stimulus package we might see in January or February.
All right, there you have it, the latest thinking from our group anyway on rate cuts and another stimulus package. With the whole crew here at the Roundtable, I'm Terry Ruffalo.